It is quite common for Australians to have an investment property which they use occasionally for holidays. The income and costs need to be split between the two types of use. It is becoming more common for people to rent out part of their home, with the income being taxable. Sometimes a home is purchased, which is later kept as an investment property, or the investment property is later used as a home. As the capital gains tax rules and the allocation of rental income are different, you will need to decide which is the best place to position the asset, either in the homes or the real estate section of the plan. There is a detailed explanation in the tutorial for those who want to explore the option of changing the property type. Some people prefer not to invest in real property. For those, you have the option of using the managed fund account and select a 100% property trust. In the asset allocation of the report plan outcomes, this asset will be included in the category Real Property and Property Trusts. No further funds will be added to this account, but dividends will be reinvested. The investment return suitable for a property trust should be entered. Returning to real property, the account details are listed on the first tab for either home or investment property. It is on this page you will also nominate when the property is to be sold, if applicable. Note that the sale of property is the year of the plan, not the calendar year. In this case, the home is currently owned and it is planned to sell the property at the end of year 10. Note that when the account is first created, loan details default to a 20-year principal and interest loan with no loan cost. To change the specific details of the loan, you must click on the link Home 1 Loan to edit the loan. In this example, the home is being downsized in year 10 with the purchase of home 2 in year 11. Note the difference in the format. Here the purchase price and the deposit are entered and the loan amount is automatically calculated. Note the default loan entries. The length of loan has been changed to 5 years so that the loan is repaid before retirement. Under the tab Fees, the buying costs default to 5% and selling costs default to 4%. In Financial Mappers Pro, these percentages may have been changed in the section Default Rates. The options for both fee types are the default rate as a percentage, a specified rate as a percentage, or a dollar amount which is indexed. Under the tab Investment Return, the only return is capital growth for the home. This is the same default rate as the property. There is a second tab, Rental Income, where the option is required. Rental income can be nominated for various periods and you may select whether or not the income is taxable. The investment property is divided into gross income and capital growth. In addition, you need to nominate the recurrent expenses as a percentage of gross income. The same format can be applied to the specified interest rate. If you select specified interest rate, you have the option to enter the rent and recurrent expenses as dollar values by unchecking the tick box. The program then converts the information to a percentage. Check that you have added the capital growth percentage, as this may default to 0%. Once the dollar value for the first year's gross rent has been established, this value is indexed at the inflation rate of 2.5% thereafter. The recurrent expenses are calculated as the nominated percentage of the gross income for each year. Both types of property can have building improvements, however only the investment property can have a building write-off. This is a non-cash tax deduction. In this example, the home renovation is going to be undertaken in year 2. In addition to including the cost of the renovation, the expected improvement in the property value can be added. This listed cost is deducted from the transaction account at the start of the year. It is possible to either refinance the home loan to fund this expense or create a new unlinked home loan. Where the last option is selected, the funds will be deposited into the transaction account and this will be discussed in the loans section. The building improvement is listed as the indexed increased value and the value of the home is adjusted accordingly. For the investment property, current building write-off settings can be entered. This is where last year's tax return may come in handy. On the same page, any planned building improvements can be listed. In this case, there is to be a property extension and kitchen renovation. Note that in addition to listing the cost and the increased value, the expected building write-off base cost can be entered. The value is used to calculate the additional building write-offs. In the investment property, but not the home, depreciation and capital purchases can be included. On the tab Depreciation, the current status of the written down value of previous purchases can be entered. To keep things simple, just one nomination can be made for the number of years over which the purchases are to be written off. On the tab Capital Purchases, new purchases are added. In this case, the cost of kitchen appliances is to be written off over 10 years. These purchases are funded from the transaction account. Financial Mappers has a substantial array of loan features. It has been designed to minimise data entry, so for long-term modelling you may leave them as the default entries. You can click between the 4 loan types and all the other data previously entered, such as interest rate, loan cost, etc., will remain. The first concept to understand about loans is that of linked and unlinked loans. For assets, whether a home, investment property or share portfolio, you can have one loan linked to that asset. If the asset is sold, then the linked loan will be repaid at the time of the sale. If equity calculations have been activated, then these calculations will apply to the linked loan only. If the loan is an unlinked loan, you will need to repay the loan manually. In the case of Home 1, there is a linked loan. Note that the program automatically gives the loan a name based on the name of the asset. This is the linked loan Home 1 loan. If you recall, a building renovation was to be undertaken in year 2. Look at the property transaction graph. The funds for that loan is deposited into the transaction account at the start of the year. At the same time, the cost of the renovation is deducted from the transaction account also at the start of the year. The cost of the loan application, mortgage insurance and fees are also deducted at the same time. In Financial Mappers, there are 4 loan types which may be used: interest only, principal and interest only followed by principal and interest with options which include introductory interest rates, a redraw facility, which is like an offset account, and loan refinancing. With an interest-only loan, only the interest charge is paid each year. The capital is repaid in full at the end of the loan period. No additional payments can be made for an interest-only loan. The principal and interest loan is intended for simple loans where additional features are not required. You may want to use this loan type, principal and interest loan with options, as it will immediately give you the options to develop your plan. However, it is just a matter of changing the loan type if you want to change ideas later during the plan construction. With the principal and interest loans, you have the option of making additional payments. These payments can be either monthly or annual. The monthly payments are deducted from the transaction account in the section Monthly Payments. Annual payments are deducted from the transaction account as an annual transaction at the start of the year. The reason is that annual payments are likely to be one-off events. Annual payments are not included in the loan expenses for the investment plan. The first graph shows the loan balance with and without additional payments. The column at the end of the green line displays the total interest and loan costs with and without additional payments. The second graph displays the additional payments in pale blue. If you currently have an interest-only loan but you expect this will at some future date be converted to a principal and interest loan, you can combine the 2 loans. Please note that if you are importing data from the starting position, only the interest-only portion will be imported. You will need to manually make the adjustment when the plan is created. This is an example of how such a loan has been used for this plan. With the principal and interest loan with options, there are 3 additional options you can use. On the tab Interest Rates, you can include an introductory rate and nominate the number of years for this lower rate. Having a property offset loan account is beyond the scope of financial mappers. However, you can make an approximation of this account using the type redraw facility. The rules of the redraw is that you can redraw any additional payments you have made to this loan. This means that you can see the amount of these payments for each year. You can, of course, withdraw those funds at any time. This is similar to an offset account. With those additional payments, the loan will be repaid in year 6, but you can see there is the value of the funds that you could withdraw if required. If you withdraw all the available funds, say in year 5, the length of the loan is now extended. Note the negative capital costs because the capital has just been withdrawn. As the client has continued to make these additional payments, the redraw again is increasing. You may recall that the plan includes an extension and kitchen renovation. The total cost is $80,000 when the kitchen appliances are purchased. These costs are going to be funded by refinancing the current loan. To create the new loan, click on the tab Refinancing. Tick the refinance box and enter the year you want to commence the refinance. Note that these dates are relevant to the loan. So in this case, the refinance is 2 years after the loan was commenced. The additional loan amount is $80,000. No deposit has been included. Where applicable, this allows the correct equity calculations to be made. Once this information has been saved, you should click the link Property 1 Loan Refinance 1 and make further adjustments to this new loan. Now you have 2 loans which you can toggle between using the chevrons. Note you can refinance the loan multiple times if there is a need. On the top graph, the purple column is the additional loan amount. Note how the loan payments have been increased with the new loan conditions. The detailed loan summary gives a complete review of the 2 loans. Note the last 2 rows relating to equity. On the tab Interest Costs, you can change the rate from default to specified. You can also nominate the time period the interest rate is fixed. You can also tick the box for tax deductible where appropriate. Where you are using the loan modulator and the rate is listed as fixed, that rate will not be changed for variable rates. The loan modular allows you to raise all interest rates, variable and fixed. This option is included so that you can consider a different outcome to your plan should interest rates return to the long-term rate of around 7%. In addition, the rate for all interest rates can also include a figure for variable rates. In this example, the variable interest rates are starting to increase in year 3 and the fixed interest loans in year 10. The 2 graphs at the bottom of the page demonstrate the change in monthly payments for a 20-year term. The options for loan costs are a percentage of the loan or a fixed dollar amount. Where it is a new loan, you have the option of including loan application fees and mortgage insurance. On the investment plan, all the home and investment loan expenses are included. The exception is additional loan payments made annually. The loan expenses are adjusted for any net rental income. In this example, the red columns are the loan expenses. No allocation has been made for the property trust. The balance of funds is therefore transferred to the transaction or bank account. When real estate is sold, the balance of the funds after selling costs and repayment of the linked loan, if applicable, are deposited into the transaction account at the end of the year. All real estate is sold at the end of the year and purchased at the start of the year. Home 1 is sold at the end of year 10. These are the calculations to determine the profit on sale. Property 1 is also sold at the end of year 10. Note that the capital works deduction or building write-off is written back to calculate the profit on sale. This is the value used in the tax estimator to calculate the capital gains tax. The tax estimator will list all the relevant information including interest costs and non-cash tax deductions. This is the data view from years 6 to 10 where both the Home 1 and Property 1 were sold. This is a graph view of the tax estimator. Note the year 10. On the Chevron report, plan outcomes can be accessed. The plan consists of a transaction account, property trust, investment properties and homes. Look at the graph view in year 10, where both the home and property were sold and the new properties purchased in year 11. The cash from both sales are sitting in the transaction account at the end of year 10. Thus, for a brief moment, the money to be used to purchase home 2 is listed in the investments. Debt servicing ratio and return on investments for all assets are included. The asset allocation, investment profile, asset allocation of investments and risk profile are all displayed. For more detailed explanation, refer to your tutorial. Financial Mappers is designed to be educational and fun to use. Sometimes it's not about creating complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions. We like to think you can use Financial Mappers as a doodle pad where you look at very simple concepts and then try to understand what is likely to make the outcome better or worse for you.